In this video, I want to now illustrate how to do a statement of cash flows. In the previous video, I explained some of the things, the introduction about the statement of cash flows and some common areas that I've seen for students. So hopefully we can use that information in the preparation of this statement of cash flows. And everybody's got perhaps a different approach as to how to start the statement of cash flows, but I'll share with you how I do it and what works for me, and maybe that will help you. So, it could be thought of as a four-step process if you would like to have like an approach. The first item that you'll do is identify what your goal is. And of course, with the statement of cash flows, our goal is to explain the change in cash from one period to the other. Okay, so identify that amount, because after you do all this work, that's what you're going to verify. Second step is use all the given information. Okay, don't tackle anything on your own until you go through all the given information in a problem in order to compute the cash flow effects. And then once you're done with that information, then you're going to analyze the remaining accounts on your own, which may mean that you will have to come up with some assumptions in terms of what are the transactions that most likely occurred that affects the statement of cash flows. And I'll show you what I mean by that. And then finally, once you're done, you're going to verify that you met your goal. Okay, so if we look at this statement of cash flows right here, you'll see we have the operating section, the investing section, and then the financing section. And I prepared a little bit of the information that we're going to be using for a particular problem just to save on time here. But nevertheless, you create your three sections. You start with net income, and then from there you're going to reverse things out. So let me show you the problem that we're going to do here. This is a problem from the Wiley book on intermediate accounting, and we'll do two problems. We'll start with this one. So here we're giving comparative balance sheets as of 12/31/17 and 16, and we're going to use this information to come up with a statement of cash flows. As I illustrated, the first step is to identify your goal, right? So when you look at the cash account, you notice that cash increased from 700 to 815. So that's 115 that we're going to have to explain, and that's our goal. So when I go to my statement of cash flows, the first thing I will do is I will put 115. I will make sure I'm getting ahead here. I'll make sure that this is what I eventually will come up with. The net effect of all these three sections should come out to be 115,000. So this is just a note for myself right here. All right. So that's the first thing. That is our goal. Okay. The second step is let's use all the given information to analyze the accounts. Okay. So let's go ahead and see what they tell us. So the first item they tell us is that on December 31st of 2016, Sullivan acquired 25% of Myers Company's common stock for $275. So in other words, before this year started, which is the fiscal year ending 2017, we had already invested 25% in another company. And since it's 25%, we use the equity method of accounting for it. Okay, so keep that in mind. On that date, the carrying value of Myers' assets and liabilities, which approximated their fair values, was $1.1 million. So that information is not relevant to us. That's just what Myers is worth. But what is relevant is that Myers reported income of $140,000. So for the year ended 12/31/17. That's important to us because if we use the equity method, we have to incorporate 25% of that. So I'm going to go into my accounts here, and if you notice, I created a T account for investment Myers Company, and the reason I created that account is because they gave us that information. So they're saying that we started at 275 and ended at 310 with that account, and you can look at that by just looking at the investment in Myers. So I'm looking at this information right here. And I'm going to explain that change. So from 275 to 310, one of the things that occurred is that that account went up by the amount of profit that I have to incorporate, which is 25%. And that equals $35,000. So when I go in here and I put $35,000, that's a debit to the investment. And if you recall from when you did this first part, when you have the share of income from an investment that is accounted under the equity method, when you incorporate that, it increases the investment account and it also increases the income. But this increase in income did not require a cash outflow. So because of that, you're going to go to the statement of cash flows, and if you notice, I have a line here that says minus the change in equity investment for the profit that was recognized. So that's minus $35,000. Okay, and I'm trying to use the same color coded in here so that you can follow along if that helps you. And then the next question is, if I take 275 plus 35, does that give me 310? And it does, right? So let me read on, because if for some reason there were dividends involved, it would have been a credit here and a debit to cash, right? And that would have been the cash flow implication, just like here. But it might be the case that there's no dividends. So let's go ahead and see what we are told. No dividends was paid on Myers Company stock during the year. Okay, so even though we incorporated part of the profit, there was no dividends. So technically this is zero. Now, once I have explained an account and I have accounted for its cash flow implications, then I could just kind of put it away and say this one's done. Okay, that's why I put all these little bars here. And at the same time, on the actual information, I can cross it out and say, okay, I did that. I don't have to worry about that anymore. So just for the sake of illustration, we're going to just highlight them in blue every time we explain them. Obviously, if you have it on a piece of paper, just check it off. All right, second item. During 2017, Sullivan loaned $300,000 to TLC Company, which is an unrelated company. TLC made the first semi-annual principal repayment of $50,000 plus interest at 10% on December 31st. Okay, so let's deal with the first part. Of course, this has a cash flow implication, right? So let's go ahead and create that account. We should have an account for the loan somewhere here. Here it is. So here's the loan receivable. Notice how loan receivables, oops, sorry, I didn't mean to do that. Notice how the loan receivable started with 0 and it ended with 250. So let's go ahead and create a T account that we can analyze, and that's 0 to 250. So the first thing that occurred is that we loaned out this money, so receivable went up. Okay, and the credit to this was that cash went out, and that's where I have this issued loan. I just wrote that. So you issued a loan, so cash went out. Okay, and recall that when we do the investing and the financing sections, we're directly doing these. We are actually analyzing what's going on within each account. So keep that in mind as well. Okay. Okay, so the next thing that we are told is that they paid, let's go back over here just to see it. They were paid the semi-annual principal repayment of $50,000 plus 10% interest. Okay, so in terms of that 10% interest, whatever that interest revenue is and the cash flow implication of it, that's already reflected in net income. Okay, so we don't have to worry about that interest because of that. But we do have to worry about that $50,000 principal payment. Okay, so that would reduce the loan receivable by $50,000. And that would be an inflow here. Received principal payment for $50,000. Okay, and that, if you go from 0 plus 300 minus 50, that gives you 250. So that fully explains that loan receivable account. And on the actual information, we can go in here and highlight that one in blue as well, like we did before, because that will indicate to us that we no longer have to deal with this transaction. Okay, now again, I'll repeat what I said with respect to the interest. Okay, the interest would have been 10% of the $300,000 loan, right? So that would have been $30,000 in a whole year, or if it's a partial period, whatever that may be. We don't have to account for that again, because when that occurred, we recorded a debit to cash in the books and a credit to interest revenue, meaning that the cash flow implication of the interest is already reflected in whatever net income is, okay? And we don't have that information yet. So because of that, we don't have to worry about the interest component. All right, let's look at the next item of information. On January 2nd of the year, Sullivan sold equipment costing $60,000 with a carrying amount of $38,000 for $40,000. Okay, so let's look at this. This is sold for $60,000. So I'm going to recreate this journal entry. I'm going to go in here and say cash is $60,000. Since they told us that the carrying value was 38, in other words, the book value is 38, then that means that the accumulated depreciation on this asset is the difference, or 22,000, right? And they're giving us this information, but do keep in mind that if you are ever doing this, of course, you're going to have to update the depreciation up before you sell the asset, right? So you update the depreciation so that accumulated depreciation will reflect the correct amount. Here they do it for us, so that's real nice. Okay, they also tell us that the cost of this item, property, plant, and equipment, is $60,000. You don't have to recreate the journal entry as I'm doing here, but I find it easier to do that. And when I do this, the math here, I'm sorry, did we get 60,000? I think I made a mistake. Oh, we got 40,000. My bad. So this should be a cash for 40,000. Hopefully somebody picked up on that as I made that mistake. And then we have 62 here and 60 here, so this gives us a gain. Oops. This gives us a gain. Bear with me if I can get this straight. There we go. Of $2,000. Now, why did I recreate this journal entry? Just to make my life easier, okay? Because I directly know what the cash flow implication is right here. So I'll go in here and say sale of property, plant, and equipment. So that gives me positive $40,000. Okay, and I've explained that. Then I go into the accumulated depreciation account, which I created right here, which started with $1,040,000 and ended with $1,165,000. So that's this one right here, $1,040,165. And then here's property, plant, equipment. Started with 2.9, it ended with 3.3. So that's what this is, 2.9 and 3.3. So I'm going to post this debit here of 22,000. Perhaps it would help to put a comma here so that you can see the numbers easier. So let me do that. It does get tricky when the numbers get so big. One more and then we'll be good. Okay, so I've posted that one. Then I'm going to post this here. So I'm going into these accounts and directly explaining what occurred in there. And then finally, this gain is a gain for which we have to subtract out of net income. Okay, so we'll go over here and put minus $2,000. And if you want an explanation, you can watch that previous video as to why you subtract the gains and you add the losses here. Okay, so let's go back to the problem itself. Okay, so far that's what we have. We subtracted the gain on the sale of the property, plant, and equipment. So now we need to look at these right here. And if we're told information, well, first of all, does it balance? So when we go 2.9 minus 60, does it give us 3.3? And of course not. So we're missing a debit of something. We just don't know what that something is. Okay, so we'll figure that out. We'll wait until the end to see what it is. And then here, we're missing a credit because 1,040,000 minus 22 does not give you 1.165. So again, something is missing here that we don't know. Now, most likely, this is going to be the depreciation for the period, right? But let's just wait until we look at all the information given before we start making the assumptions that are step 3. Okay, so right now we are in step 2. We're just using all the information that's given to us. And then we'll go into step 3. Okay, so let me go back to the actual problem again. So we've done number 3. Number 4 says, on December 31st of 2017, Sullivan entered into a capital lease for an office building. The present value of the annual rental payments is $400,000, which equals the fair value of the building. So Sullivan made the first rental payment of $60,000 when due on January 2nd of 2018. Okay, so this involves the next fiscal period, but this involves this period. So that could explain what the difference is in property, plant, and equipment, except that we did not have to pay cash out. This is a lease. So this might end up in a non-cash activity. So let's go ahead and look at it. So they're telling us that $400,000 came in here. And then the credit here would be to a lease liability, which I don't have it here, but if you go back to the problem, you'll see how, if you wanted to, you could create that T account. It went, lease liability went from 0 to $400,000. So that would explain that increase in that liability. So when we do this transaction, this would be a non-cash activity from investing purposes. So we would go in here and write property, plant, and equipment lease of $400,000. Okay. So if you notice, this fully explains the property, plant, and equipment because 2.9 plus 400 minus 60 gives us 3.3. So I'm done with that one. I'm going to cross that one out. That also fully explains the lease liability account, for which I didn't create a T account. But if you wanted to create a T account just to visualize everything, you could. But when you go to the original information, now you have explained this one here, the property, plant, and equipment we just talked about. And you've explained the lease liability, even though we didn't do a T account for it, doesn't matter. Okay, so look how little by little we are addressing some of the issues based on the information given. And then finally, we are told that net income for 2017 was $370,000. So I'm going to analyze the retained earnings account, okay, because that's where it would go. So we started at 2.6, roughly 2.7, and ended at 2.9. So let me go and do a T account for that, and that's right here, 2.6, 2.9. All right, so let me put some commas here, make it nicer. All right, so they told us that income was $370,000. So when you close the books, okay, when you close the books, you credit retained earnings for the net effect. Okay, so you have 370, you close your revenues, you close your expenses, and the net effect is what comes in here. I know it would, the expenses would come in as a debit and the revenues would come in as a credit. But if you summarize this in an income summary account, it comes in as a 370. So that's the 370 that we're going to use right here. Okay, and I hope you can read that color there. I'm trying to color match everything so it looks real nice. And the next question is, okay, so 2.6 plus 370, does that give us 2.9? And the answer is no. So we're still missing something on this side. Okay, and we're going to wait. We're not going to make assumptions yet. We're not going to go to step 3. We're going to keep using the available information. But you can start thinking about this, and most likely this is going to be related to dividends, right? Because into the retained earnings account, you put in your income or your loss, and if you're paying dividends, that's where it comes out of, right? So most likely that's what it is. But let's wait. Let's not make assumptions yet. All right, let's read on. The next item says Sullivan declared and paid the following cash dividends for 2017 and 16. All right, let me scroll down a little bit. Oops, that's not what I wanted. There we go. So this is, let's see, they're declared in 2017. We declared dividends of 80,000, and they were paid next year. So this is going to help us for the dividends payable account. So notice how the dividends payable account went from 100 to 80,000, and we're going to recreate that information. Then the other thing is, on December 15th of previous year, 100,000 was declared, but then it was paid this year. So for purposes of what we're doing here, we're going to analyze only what affects this year. Let me highlight this. Maybe that'll help us visualize this. So when I go to the T account to recreate this stuff, I'm only going to worry about what affects 2017, right? Because that's the fiscal year that I'm analyzing. So in 2017, I'm going to have a declaration of 80. And then in 2017, I'm going to have a payment of 100,000. So let's go ahead and see how that is reflected. So here's the dividends payable account with the information from the comparative balance sheet. Started with 100, ended with 80. Recall they told us that 100,000 was paid in 2017 in February, to be specific. Okay, so let's go ahead and recreate that. So I'm going to put in here, this is just to put a date so we can kind of keep track of this. On February 28th of 2017, we paid $100,000. So in other words, you debited dividends payable and you credited cash. So that has a cash flow implication that needs to be explained right here, and you say dividends paid of negative $100,000. Okay, and I have these formulas already set up so that it adds and subtracts all this stuff, just as you can see here. And then at the end, this is just going to net all of it. Now, keep in mind, what's our goal? Our goal is to explain a positive 115 increase in cash. We're not done yet. So little by little, that's what this number is getting to. Okay. The other thing we know from the fiscal year 2017 is that at the end of the year, we declared $80,000 of dividend. That's right here. And that, of course, comes out of retained earnings, right? So that's the journal entry that you would have done to make that declaration of the dividend, right? It does not have a cash flow implication, but it does help us explain these two T accounts, because this 2.6 million plus 370 minus 80 does give us the 2.9. So right there and then you're done explaining that one. So we can go over here and highlight retained earnings because we have explained it. Okay, let's go back now and see what else. Dividends payable, this was explained as well. So we're done with that one as well. And we have included the cash flow implication right here. Okay. And notice again that these are the items that involved the fiscal year 2017. So you might be given a whole bunch of other information, but what you need to focus on is that these two transactions were 2017. Okay, let's see what else we have. If we're given any other information. So at this point, that's all the information we have. They're asking us to prepare the statement of cash flows, which is what we are doing. All right, so from now, we'll go into what I called step 3. I mean, you can call it whatever, ABC or whatever, but this is the next step. Okay, now we're done with the information that was given to us, and now we just have to come up with the most rational assumptions in terms of explaining these accounts. So we go to accumulated depreciation, and we know we need more credit in here. Okay, so most likely, what is that? Most likely that's the depreciation expense for the period, right? You debit expense and then you create accumulated depreciation. And this right here is $147,000. So how do I use that information? Well, that's an expense that reduced net income for which cash outflow did not come out. So I'm going to have to add the 147 back to go from a cash income, to go from a net income idea to a cash income idea here. Okay, and once that's done, then that also fully explains this T account. So I'm going to go in here and highlight accumulated depreciation. Okay, use whatever method works for you, okay, and just, do that. But look at what we have here. The remaining accounts we don't have information for, but we can use the simple approach that we talked about right here, that basically says you're going to add any decreases to current assets, and you're going to add, yes, decreases to current assets and any increase to current liabilities. And the opposite, you will subtract. So we're going to use that idea here. And specifically, we're going to look at the first account, accounts receivable. Accounts receivable went down. Okay, so that's a decrease in a current asset. So we're going to add that to the indirect method. So that's where over here I have a plus a decrease in accounts receivable of $40,000. Okay, and we go to the next one. Step fully explains this, just for the sake of completion. I'm gonna, oops, I did too much. For the sake of completion, I'm gonna highlight it so that I know that I fully explained that. Next, I'll do inventory. Inventory went up. So if inventory goes up, then I have to subtract that, right? So that's what we're gonna do. So I'm gonna go back to the statement of cash flows, and if you notice here, plus increase in inventory, so that's minus 135. You could technically create T accounts for everything here if you wanted to, okay? You could, but at the end, these particular transactions that you're analyzing in one step, it's just straightforward. Okay, so the next item, accounts payable. Accounts payable went up during the period. So if accounts payable goes up, then we add it, right? So I'm going to put this here. Oops. We're going to go to the statement of cash flows and include that. So plus an increase in AP, so that's 60,000. And we'll go back and see what else we're missing. We have income tax payable, okay, which we have to analyze. So we'll do that. So income tax payable went down, so we're going to subtract that. Minus a decrease in income tax payable of negative 20,000. All right, let's see what else we have. Dividends payable we did explain, so we can take that one out. Common stock, if you notice, nothing has been mentioned about common stock, but it started at 500 and it ended at 500. So most likely nothing happened. Same thing with additional paid in capital. Unless you're told otherwise, I mean, if it's the same amount, then nothing happened there. So notice how one step at a time we explained everything that occurred in this statement of cash flows. And when you net this out in terms of operating activities, the company is generating cash flow from operating activities. Very important, right? So we are generating cash flows from operating activities. That's the bread and butter of this company. We're using some of that money to invest by lending out money. And we did sell and generate some cash flow from this, but nevertheless, that's what we're using the money for, investing. So when you issue a loan, that's a type of investment as well, right? You're making money out of interest. And then finally, we use some of this money from operating activities to also pay dividends. And notice how we here have explained the increase of $115,000. All right, so that's goal number 4, where you verify that you met your goal. All right, we'll do another problem here that's a little bit more involved, just so that you can get more practice and become more fluent with the preparation of the statement. Okay, so the next statement of cash flows illustration is going to be a little bit more involved. There are going to be some items that might be confusing, so you might want to take your time. You might want to maybe take a picture of this and have it handy somewhere so you can refer to it as we prepare this one, okay? Here's the information for Alexander, and I've created some T accounts here that I know I'm going to be using for this illustration, and I'll try to go a little bit faster than the first round, since now you've been exposed to some of it. So the first thing that we'll do is get our goal, and the goal is to explain a decrease of 20,100, right? Sorry. So this is our goal right here. And again, we'll highlight it just to know, and then when we go to the statement of cash flows, you'll see that I'm putting that negative 20,100. Everything that we do in here will explain this negative 20,100, and that's important. Okay, so the next step is I'm going to go into the additional information that's given. So let me scroll down a little bit here. We get some information on the statement of retained earnings as well, but let's go ahead and start with this. It says your working papers from the audit contain the following information. On April 1st, the existing deficit was written off against paid-in capital created by reducing the stated value of the no par stock. So we have apparently a retained earnings deficit, so we're going to analyze the retained earnings account. So it started out with a negative 450 or a debit, and it ended with 20,000. So let's go ahead and do a T account for that. And what they're saying is that they're putting this into the common stock account, the paid-in capital accounts, to get rid of that retained earnings being negative. So let's go ahead and see the retained earnings account right here. Started out with 450,000. Let me remove this here. It started out with 450,000 negative, and it ended with 20. So we know that based on the information given right here on April 1st, 2017, it says they transferred from paid-in capital. In other words, they were trying to get rid of this negative balance. So they went in here and put 425,000. So the way this is going to work is that we'll have a 425,000 here as a credit, and that's going to come out of common stock. So you're going to have a debit right here. So your paid-in capital accounts have been reduced to reflect that. Okay? There is no cash flow implication from these, but we will note that in the non-cash activities for the company. So that's where this one down here says reduce the retained earnings deficit, and it reduces the paid-in capital account. Okay? Since we are there, we can analyze the net income amount as well. So let's go ahead and keep looking at what they gave us here. Net income for the year was made up of 2 entries. One was for the first quarter, 25,000, and then for the last 3 quarters, it was 90,000. So there were 2 amounts that were closed during the year to retain earnings for net income. I know this looks weird, but just it's as easy as if it would have been one amount, then it would have been the summation of those two, or 115. But nothing wrong with having two of them. So quarter one, it was 25,000 that was closed into this, and then quarters 2 to 4, that was 90,000. And what that information helps me determine is that net income for the period was 115, the summation of those two. Okay? And then finally, I'm going to use the information within the statement of retained earnings to see that they declared a dividend of $70,000, right? So let me see if there's a dividends payable account here. There is, okay. So there's a dividends payable account. So notice how this went from 0 to 70, and that's probably what this is. So let's go ahead and recreate that. So I'm going to debit retained earnings for that dividend declared, and I'm going to credit dividends payable. Now, what's important here is that this doesn't necessarily have a cash flow implication. If we would have paid dividends with the debit here, that would have a cash flow implication, but we're not told otherwise, so we're going to have to assume that none of that was done. So that fully explains the retained earnings account. We've used anything that we needed for cash flow implications, and that also fully explains the dividends payable account. So just like in the other example, I'm going to highlight the ones that I've used already so that it makes my life a little bit easier. Oops. Sorry, I'm making this screen jump up in different colors. All right, so this one, fully explained, retained earnings, fully explained as well. Okay, so we'll use the next information that is given to us, and we'll go ahead and do that. So the next item they tell us is that on November 1st, 2017, 29,600 shares of no par stock was sold for $257,000. Okay, so that's going to be a financing activity. The board of directors voted to regard $5 per share as stated capital. So this is going to be our par value, $5 per share. That's all they're saying. So we will need to compute 29,600 times 5, and that'll be the credit to common stock. But the whole sale was for 257, so that would be the cash flow implication. So we'll go ahead and do that journal entry to visualize it. So cash came in 257,000. Oops, I missed the 7. And you don't need to do the journal entry, but I like to just to visualize. And then this is going to be 148,000, which is the number of shares sold times $5. And then the additional amount, the remaining amount, is additional paid in capital. So that's $109,000. So we'll go in here. This is the cash flow implication. So that would be issued common stock, and that's going to be a positive 257,000. That takes care of this part. Then we post these two items. So this is going to be 148,000. And this one is going to be 109,000. So if you notice, that fully explains the common stock account, and that fully explains the APIC account. So we'll go ahead and cross those out. We're done. And then on the actual trial balance or comparative balance sheet, we're going to also highlight them and say we have explained these fully. You want to be organized when you do this, because if not, you can lose track of what it is that you're doing. Okay, so that's why I do this. Okay, so the next item they tell us, this is first we're going to tackle the given information. A patent was purchased for $15,000. So let's go ahead and create the T account for patent. Here it is. Started out with 64,000. It ended with 69. So I'm going to debit the patent. That's the actual transaction that occurred, and credit cash. So that credit to cash is what we're going to go in here and say purchase patent minus $15,000. Okay? Now notice, if I add 64 and 15, it does not come out to be 269. So most likely something else happened. But we're not given that information yet. So don't make assumptions until you're given that information. Now, what most likely happened is that you maybe sold the patent. That could have been, right? But keep that information pending until you get additional information. Don't make assumptions until you have to. All right, so next item. During the year, machinery that had a cost basis of 16,400. That was the historical cost. This is what it cost us. And on which there was accumulated depreciation of 5,200 was sold for 9,000. No other plant assets were sold during the year. So let's recreate this transaction. Okay? And let's do it right here. In terms of cash, we receive 9,000. We get rid of the accumulated depreciation of the machinery of 5,200. This is given information. And then we get rid of the machine for the original cost, which was 16,400, they told us. And then this ends up giving us a loss of 2,200. Now, you know that this loss here is going to be added back to the operating activities, right? So we'll do that soon. You also know that the cash from the sale goes into the sale of the machine. So we're going to go in here and say cash. It doesn't matter what order you go to, but I'm just going to start one item at a time. So cash came in, the sale of a machine, that's 9,000 positive. Accumulated depreciation, I'm going to post it to here. If you notice, this does not balance. So again, most likely this is going to be your depreciation for the period. But do not make that assumption until we have to. Then we credit machinery for 16,400. I'm just recreating everything. And then finally the loss would be added back over here. So that's 2,200. Okay. So notice how this also doesn't balance out. So there's still something we need to know about machinery here. Most likely we purchased machinery, right? But we don't know that yet. So we'll hang in there until we find that information. Let's go back to the given information. Then we're told that these bonds, the 12% bonds, the 12% 20-year bonds were dated and issued on January 2nd. Interest was payable June 30th and December 31st. They were sold originally at 106, and then they were redeemed. In other words, they were paid off on March 31st. And notice number 6 is also another transaction involving bonds, okay? And this is the issuance of bonds. So this, number 5, is paying off a 12% loan, and this, number 6, is issuing a % loan. So most likely what's happening here is that the company is trying to refinance their loans, right? And I think we'll do these two last because these are pretty involved. I want to do everything else, and then we'll come back to this at the end, okay? So let's go to the next thing. 7. Alexander Corporation acquired 70% control in Crimson Company on January 2nd for $100,000. Okay, so that's going to be an equity method transaction because it's greater than 25%, right? And we'll have to account for that, the income as such. So when the company that we invested in reports $15,000 of net income, we incorporate 70% of that in our books. So let's go ahead and look at the investment account. So here's the investment. Started out 0, ended 110,500. That's from what is given here. Okay, so I'm getting all this information from the balance sheet, the comparative balance sheets. That's what this investment account is. All right, so that's what we're working on. So So let's go ahead and do that. They told us that we invested $100,000 into that company. Okay, so that's our original investment, and that obviously has a cash flow implication. This is the investing activities. So we're going to go in there and say, for that investment, we took out $100,000 in cash. Now, the other thing that occurred is that we get 70% of the $15,000 of the income reported. And that right there is $10,500. But do keep in mind that this is going to be a debit to the investment, and it's going to be a credit to income. But that credit to income does not have a cash flow implication. In other words, this net income of $115,000 is reflecting that addition of $10,500 for which cash was not involved. So because of that, I'm going to have to subtract it out, and that's what I have here, minus change in equity investment. So I'm going to subtract the minus $10,500. Okay, so that fully explains the investment account. So we can move on to the next item. Okay, so the next item, and again, we have 5 and 6 to do at the end just because they're a little stressful, so I'm going to wait. Number 8 says major repairs to buildings of 7,200 were charged to accumulated depreciation of the buildings. Okay, so this is not just regular repairs, these are capital expenditure. And if you remember from way back then, the capital expenditure is something you can capitalize and then depreciate over time. So the way we're doing this is as a reduction of accumulated depreciation. So that increases the book value of the asset. So let's go ahead and do that. So we have building over here, the accumulated depreciation of the building, and then we have building next to it, okay? So what they're telling us is they are debiting the 7,200 into the accumulated depreciation, and then that's a credit to cash, so that's a cash flow implication, and we'll put that over here. That's an investing activity. We're investing in property, plant, and equipment, and that's minus 7,200. Okay, now this doesn't fully explain the account because 400 minus 7,200 does not give you that. So most likely, again, this is going to be depreciation. But we'll wait until we have to make that assumption. We won't make that yet. The other thing here is building went up. So most likely we purchased the building, but we don't know the full details, so we'll wait. All right, let's go to the next thing. Interest paid during 2017 was $10,500. So this interest paid is already reflected in income as interest revenue, and it's already reflected in cash. We'll see how this pans out with all the bond stuff that we have to do. You'll see later on. And then finally, income taxes paid were $34,000. So let's go ahead and analyze the income taxes payable account. And I put that here. Okay. So started out with 79,600 and it ended with 90,250. So they say they paid 34,000. Income taxes paid were 34,000. So if that's the case, that's a debit of 34,000 to the account. Debit income taxes payable, and then credit cash, right? So this is going to be reflected in this section right here. All right, so normally that would, this amount that you've paid has already affected cash, right? So we also have expense that is recognized during the period. So this portion of the transaction itself has already been reflected in the decrease in cash for the period. In other words, the cash ending balance, I don't know how to stop it from doing this. Let me do it like this, that's better. So the cash ending balance already reflects a reduction of 34,000. So that part we're not too concerned about. The part that we're concerned about is the difference here, because that amount is the additional expense that was recorded during the period for which a cash outflow was not required. So in other words, when you do this analysis right here, you'll see that what we need is $44,650 to make this account balance. Okay, so hear me out on this one here. This account went up by $10,650. Okay, so there was an increase, overall increase of $10,650. So it's like an analysis of a working capital account. If a liability goes up, then we have to add it because we basically have recorded more expense. And this is the expense, by the way. We have recorded more expense than the cash that went out. So I said earlier, this is the cash that went out during the period. But we recorded an expense of $44,650 for which cash, the amount of cash that went out was only $34,000. So we have to add back this $10,650. And if you wanted to analyze it in a simpler way, this is a current liability, right? When current liabilities go up, then all you do is add it back. So that $10,650 would go, what line did I do for that? Here we go. Increase in income tax payable. So because of that, I'm going to go $10,650 on the statement of cash flows. And what that does is that allows us to fully explain income tax payable account. So let me go back over here in the liability income tax payable. I'm going to highlight that one because we have fully explained it. So notice how we still have a lot of things to explain, but we'll get them little by little. This is going to be a long video. You're going to have to pace yourself, maybe stop once in a while and take a break. All right, the next item that we're told, let's go ahead and see what we have. And that's it, right? So everything else is going to have to be assumptions. But before that, let's go ahead and do number 5. Okay, this is where we paid off a loan, a 20-year, a 12% loan. We paid it off early. Now, interest is payable June 30th and December 31st. They were sold originally for $106, so this was the premium originally that we're going to have to account for. And these bonds were redeemed at 100.9 plus accrued interest on March 31st, 2017. So if we redeem these bonds on March 31st, it means that 3 months have passed since the last interest payment. So we're going to have to accrue that interest amount before we redeem these bonds. And we're redeeming them at 100.9% of face value. Right? So let's go ahead and analyze this. This is going to be a little bit involved. So this was a $100,000 loan, okay? And this is the premium related to it. This is the beginning balance. Now, is that given to us? Here's the beginning balance, $2,400. And then here is the bond payable, 12%, that I'm recreating over there. Okay, so let's go ahead and look at those. Now, let's start by looking at how we arrived at $2,400. All right, this bond initially sold at $106, so the original premium was $6,000. And since this was a 20-year bond, semi-annual, it was 40 semi-annual amortization periods. Meaning that if we were using the straight line amortization, it would be amortization of $150 every 6 months. Now, how many years have passed since the issuance of that bond? So let me look. This bond was issued January 2nd of 2005, and now we're in 2017. Oh, I'm sorry, 2016. Okay, before we do this adjustment, this is the beginning balance, right? So that's going to be a total of, and I'm going to do my math here and then I'll get back to you so I can make sure I get the right amount of years. Okay, so just to be clear, I actually counted year by year from 2005 all the way to 2016 before this transaction needs to occur. And yes, I used my fingers to count just to make sure I don't miss any years, right? So it's 2005, 2006, and so on until 2016. And that gives me 16 years. So 16 years, these are half years, right? So if it's 16 years, that's 32 6-month periods. In other words, let me hyphen this, 32 6-month periods. So in other words, the amount that has already been amortized to date is going to be 32 times 150, which is what it was every 6 months, right? And 32 months, 32 6-month intervals have already passed. So that gives me 4,800. No, that doesn't seem right. Did I do? This actually should be 12 years, I believe. Sorry about that. 12 years is 24. I don't know where I put 16 years. This is 24 6-month intervals. Let's see if that works out. Yeah, okay. My apologies. So since 2005 until 2016, the end of 2016, that's 12 years, which is 24 6-month intervals. And this 3,600, this is what has already been amortized. Okay, so notice the original premium started at 6,000. This has already been amortized, so that's how we are currently at 2,400. Okay, so that's not very important, but it is good to understand where these numbers are coming from, right? Now, we're going to be doing the amortization for a 3-month period. So from January 1st, 17, oh yeah, I'm sorry, this right here, I put 1/1/2017. This is the beginning balance in 2017. But from 1/1/17 until 3/31/17, that's where we're going to be recognizing the amount of interest that has accrued and the amount of amortization that we need to accrue. Okay, so this bond is a $100,000 bond that pays 12%. Okay, that amounts to $1,200 per year, or if you want to look at it this way, 12,000 per year. 12,000 per year, or on a 6-month, or 6,000 every 6 years, every 6 months. I'm mixing everything up at this point, sorry. Okay, so it pays, this bond pays $6,000 every 6 months. That's what it's always been. But here we have a partial period. We have a period of only 3 months. So when we redeem this bond, think about it, we're not going to pay 6 months worth, we're only going to pay 3 months worth. So that's $3,000. So this is a credit to cash of $3,000. Because when we redeem that bond, we have to pay the accrued interest involved as well. Now, we also have to amortize a little bit of that premium. And the amortization every 6 months is $150. So naturally, if it's only 3 months, it's going to be half of that. So this amortization is going to be $75. And then finally, this gives us an interest expense of $29.25. Okay, so let's put things into perspective here so that you don't lose track of what we're doing. We're trying to account for this redemption, okay, where we pay off this bond early and we pay it off at this amount. But before we can actually do the redemption, we have to accrue interest from January 1st until March 31st of 2017, because that has not been done yet. So that's what I'm doing right here with this transaction right here. This is the interest from January 1st to 3/31. Okay, so now we post this information here. That gives us $75 right here. And the amount of cash, this has already been reflected in the cash balance, And this is also already reflected in net income. But here's the thing. Net income was reduced by only $29.25, right? But the cash outflow was $3,000. So we need to go in there and reduce the premium from the operating activities. So if you notice, I have here minus premium. I'm going to put this as minus $75. And just for the heck of it, let's color match this so that we see how things are going. If I can find that violet color, I don't know if I can. All right, let's see if this is it. Doesn't look like it, but you know what? We'll do this one as such. Okay, so there's that $75. And honestly, I don't like that color. It's hard to see, so I'm going to do it in red here. Oh no, I already have red. My apologies. This is highlighted. I know this is maybe unnecessary, but sometimes, I mean, it does help to track what we're doing with the colors. Okay, so that's where that's at. All right, so now think about it. Now we have to redeem this bond. We have to pay it off. So we're going to debit bonds payable. This is the transaction on 331. We're going to debit bonds payable for the $100,000. That's this amount right here. We got to debit it to get rid of it. We also have to get rid of whatever balance remains in the premium. So 2,400 minus 75 leaves 23.25. So we need to get rid of that as well. $23.25. And then we also have to put in how much cash we're paying for this. And since it's 100.9%, this is going to be 100,900. So what remains is for us to note whether this is a gain or a loss. So this is a gain on redemption of $14.25. So we'll go ahead and write that down. Okay. Now let's start thinking about the cash flow implications here. This cash amount needs to be reflected on the financing activity. So we're going to have a minus 100, 900 here. Okay, so that's that right there. Then the gain on redemption needs to be subtracted out from operating activities because your net income reflects a gain for which really there was no cash inflow, right? So we're going to go in here, and I have one of these set up for that. Here's the gain on redemption, so that's going to be subtraction of 14.25. Okay, we'll go in here and put in the premium of 23.25, and then we'll put the $100,000 right here. So what you'll notice is that this fully explains this account, and this fully explains this account as well. So we can cross those out, and we can also go on the comparative balance sheets and highlight them so that we notice that we are done explaining the 12% bond. Now, mind you, we still have to explain the other one. And this one had a premium. So here's the premium that we explained. Let me just make sure that's what I'm talking about. Yes, this is the 2,400 premium that went to 0. So that's this one here. So we can highlight that one as well. All right, so now we go into the one on these number 6, the 8% 40-year bonds that were dated January 1st that were sold. So this is going to be cash coming in, and they were sold at a discount of 97 plus accrued interest. Now the accrued interest that we're talking about is that these bonds were dated January 1st, but they weren't sold on January 1st. They were sold on March 31st. So there's an accrual of interest for those 3 months that you need to account for. This is the topic of selling bonds between interest payment dates, because this bond pays semi-annually on June 30th, and on December 31st. And just to complicate things a little bit more, there were some underwriting expenses of $839 that we have to account for. Okay, so let's go ahead and try to do this particular problem. So what you'll notice here is that this company included the bond discount and the issue cost in one account. So that makes it a little bit trickier, but that's doable. The other thing would have been to separate bond discount and then the bond issue cost separately and account for them separately. You could do that as well, but here this is bulked together. And then, so we'll analyze that T account, and then we'll analyze the 8% bond that started with 0 and ended with 125. So let's go ahead and see how we're going to do that. So that's this right here. These are these two accounts that I'm doing. Okay, so the first thing that I'm going to look at is the issuance of the bond. Okay, so I sold, here, let me put it right here. I issued a $125,000 bond at 97%. They told us that. So let me go ahead and do the transaction here. This is cash, 120,411. And let me do that last so you can see what I'm talking about here. Well, actually, no, let me do that because it's going to be, let me do the math. It's going to be the 125K times 97%, which gives us 121,250. But then on top of that, I have the cost, the underwriting cost of $839. So the proceeds were 121,250 minus $839. Okay, and that's where I get that 120,411. Okay, so if I'm doing a journal entry for this, this is what it would look like. Let me do a little box right here so that we can do the journal entry. I know this is a lot of information, so just take it one step at a time. So the cash amount that came in was 120,411. Now, the bond discount and issue cost, because they mixed it together, this is going to be hard to squeeze in here, is 45.89. Okay, and that's going to be a credit to bonds payable of 125,000. Okay, so this is hard to see that this is a debit, right? So I'm just going to simplify and say discount and then issue costs so that we see it as a debit in here. So bear with me here. Okay, so that's the first thing that occurs here. Now, since this bond was issued between interest payment dates, we have another thing to account for, and we're going to do this separately. You could combine it, but since I'm choosing to do it separately because they're already combining the issue costs and the discount, so I don't want to add another factor that's being combined. But do understand that since this is selling between interest payment dates, then you're going to collect ahead of time part of the interest from the investor. And that part of the interest is going to be 3 months worth. Okay, and if you don't remember why, go back to your studying on issuing bonds between interest payment dates. So this is $2,500. So what ends up happening is that we get cash from the investor ahead of time, because later on we're going to pay the investor a full interest amount. So because of that, we get part of what that investor has not earned. We're going to account for this as interest payable, even though they don't have an interest payable account here. That's okay. And that's how we'll do that. Okay, so that's the second part of that. So let's go ahead and put this information in there. So the cash amount, that's going to go in the financing activities, right? So we're going to highlight this in yellow just so you can see it. And then this is the bond issued. So this is 120,411. 411. That's a positive because we issued bond. The discount of 4589 that goes into this account here. We're recreating what occurred in there, right? So there's a debit in there. And then the 125,000 goes right here. Again, to recreate the account itself. So that when I look at this, I can see that this account is fully explained. Okay, so I don't have to do anything else with that. And there's still something missing here on the discount and issue cost. And what's missing is that this person, this investor, received 2 interest payments throughout the year. Let me go back over here. Okay, let me scroll down. This bond, the 8% bond, was issued on March 31st, right? And this bond is going to pay interest on June 30th and December 31st. So that's going to be 2 interest payments that the investor is going to receive. So let's go ahead and do that right now. I guess we could do this below right here. So 2 interest payments. Those are cash outflow, right? So this is going to be 125,000 times 8%. And normally you would do, since it's every 6 months, you would do half a year. But since we're doing both, I'm going to simplify this by doing both payments at once. So I'm just going to leave the whole thing without partial period. So in other words, this bond is going to pay 5,000 the first 6 months, and then 5,000 the next 6 months. So the journal entries, I'm going to combine them into one. This would have been 631 and 1231. We're going to have interest expense. This is a lot of information. This is also going to be having interest payable from this amount of 2,500 that we received ahead of time. And then we're going to amortize some of the bond discount issue costs. We'll figure that out in a minute. And then finally cash. But we know the cash amount is 10 grand. Okay, so let's go ahead and put a box here to do this journal entry. All right, so give me 1 second here. All right, so here's another quirk here. This bond is for how many years? It's a 40-year bond, okay, the one that was issued. 46-month interval. So normally, that would be 40 times 2, which is 80 6-month intervals. It'd probably be easier to just multiply it times the number of months. So you got 40-year bond times 12. Let me do that instead. 12 months. So that gives me that's 4,800, right? Months. I'm sorry, 480 months. Okay. So that's a total of 480 months for the whole bond itself of amortization. But here's something you got to be really careful about, and this goes back to issuing bonds between interest payment dates. For those first 3 months that bond was not issued, you do not amortize any discount for it, because recall that this bond is dated January 1st, but it was sold March 31st. So those first 3 months, this bond was not outstanding, so it doesn't pay interest for those 3 months technically. In other words, this amortization of discount and issue costs will not apply to those 3 months. So because of that, the amortization period is going to be 480 minus those 3. So in other words, 477 months to amortize. Okay? So when we take this 4589 over here, and I'm going to amortize it for the first 9 months, I'm going to go in here and say 4589 divided by 477 months to amortize. That'll give me a monthly amortization amount. Okay? So it gives me amortization per month. Now, that amount I'm going to take 9 months for the first year because the bond was outstanding 9 months. 9 months times that amortization amount. I don't know what it is. I didn't figure it out. Amortization per month. I'm writing it the same, so you see it's the same stuff. And then the computation gives me $87. So in other words, whatever this is, let me highlight it in a different color, or paint it a different color. Let's paint it orange. Whatever that is, whatever that amount is per month, that's the amount I'm going to multiply times 9. Because for the first year, it's 9 months. So what that means is that the bond issue discount amount, the amortization amount, is going to be $87. Okay, interest payable comes out for $2,500 because that's monies we received ahead of time. And then the difference, that's your interest expense for the period. So that's going to be $75.87. Okay, the bond, the discount amortization amount, that's going to come out, well, let's post it. That would go right here, right? 87. Let me highlight it in green if I can as well, just so we see where everything is going. If I can find that green. Oops. I think that's the one, yeah. Okay, so that amount explains the account, but we got to be real careful because that needs to be added back. The discount amortization needs to be added back. So that's where we're going to put this $87. Okay, and little by little, we're building this story complete. We're putting the story together. So that fully explains this, so I can cross that out. So I told you this bond one was going to be a challenging one, right? So that's why I wanted to hold off on it. All right. The other thing I want to say is, look at these. I'm going to highlight all these in blue, like I did the first one. Hopefully I can find the same blue. That's the same blue. All these three highlighted in blue, those are things, those are the interest that we paid, the net of it. Okay, so if you net reduction of 2,500, I'm sorry, an increase of 2,500 minus 10,000 and minus 3,000, that's going to get you interest paid of, let's go ahead and do 3,000 minus 2,500 plus 10,000. That total amount equals 10,500. And the only reason I'm highlighting that is because they told us that. You know, this is, I'm going to highlight it the same color so we can keep track of what it is that we're saying. They told us that information. They told us that during the year they paid 10,500 in interest. And I'm going to show you where they said that. This is in number 9. Interest paid in 2017 was 10,500. So when I go back over here, you can think of this as item number 9. Okay, now I don't have to do anything with that because these amounts have already been reflected in cash. This has already been added to cash. This has already been reduced to cash, and same thing over here. So what we accounted for was the amortization amount. You know, what we adjusted from the statement of cash flows was the amortization amount. So notice how this premium, when we added it, I'm sorry, let me scroll up here. When we subtracted the premium of $75 and when we added the $87, that's getting us to a cash expense. Okay, when we added 75, that got us to a cash expense of 3,000. Even though we only see 75 of it, the other 29.25 is already reduced from the net, to arrive at net income. Okay, so that handles that. All right, let's see what else we can do now. I think now we have to go in there and make some assumptions because we're not given any more information. So what's the next thing I'm going to do? Well, let me go over here and highlight what we explained at this point, just to be clear. So this we fully explained. And then the bond discount we fully explained as well. Okay, so now we're going to go in here and try to figure out what things, what assumptions we can make on some of these items. So for example, let's go back up here. The patent. Okay, so for patent, we need, let me see what math I did here so we don't have to calculate this. So the patent went down by $10,000 here. Now normally you could view it as a sale if they told you it was, but they didn't tell us. So maybe what occurred here is the amortization. If you go back to your depreciation chapter, amortization chapter, you will recall that with patents, we don't have like an accumulated amortization account. When we record amortization, it just goes directly into the patent account. Unlike what we do with property, plant, and equipment. With property, plant, and equipment, we do have an accumulated depreciation account, but we don't have an accumulated amortization account. So we just go in there and put it directly in. So the easiest assumption here is to say that this amount, whatever makes it balance, is amortization of patents. And that's what I'm going to go in here and go with. So plus copyright amortization of $10,000. And that fully explains that account. So I'm going to go in here and I'm going to highlight patent so that we know that this has been fully explained. Okay, let's see what else we got. Machinery. So in terms of machinery, we need a debit in here, right? Unless we're told otherwise, the easiest assumption that we can make is that perhaps we purchase machinery, right? So to make this balance, we need $33,400. And the best assumption is that we purchase machinery. So I'm going to go in here and say minus $33,400. It's not like we're guessing it. Okay, so that fully explains that. We're not guessing. We're making a rational assumption here as to what could have happened in those accounts. For example, look at accumulated depreciation for machinery. We still need something to make it balance, and that amount is $48,200. The easiest assumption to make here is that that is the depreciation for the period. So that's where we're going to go over here and say plus depreciation for the machinery, $48,200. All right, so that fully explains that one as well. What next one? The next one we can do building. We weren't told otherwise, but building went up by $127,300. So the easiest assumption is that we purchased the building. So that's why I have this here, and I'm going to go in there and say minus $127,300. And again, that fully explains the building. So I'm going to go and highlight the building so that we make sure that we're clear that this work was done already. I believe, let's see, what else did we do? We did the machinery and accumulated depreciation of the machinery. Did we mark those? Here's the machinery, which we fully explained. And the accumulated depreciation of the machinery, we also explained. So I'm just trying to mark up stuff that I don't need to do anything else with. What we have not done is the accumulated depreciation of the building. So we can go ahead and do that. And for that, I need $31,200 to make a balance. And that's nothing more than depreciation of the building, if I can find it. Here it is. Plus the depreciation of the building, $31,200. Okay, so that fully explains that one as well. And I'm going to go in here and cross it out. All right, let's see what else we have. That's all in terms of the ones that we did T accounts for, right? Yeah. Okay, so from here on, what we will do is that we will just go down the list of any accounts that we haven't explained, and we're going to use the approach of described right here, that we'll add any decreases in current assets or increases in current liabilities and then subtract the opposite, right? So let's go ahead and give that a view. Actually, I just noticed I did a mistake. It's not a big deal. When I did the copyright amortization, it really was the patent. So I have the patent up here. So this 10,000 is not for the copyright amortization. This 10,000 was for the patent amortization. Just to be clear, okay? They're both intangibles, but I mixed them up. So when we did this analysis and we credited 10,000 here for the amortization of the patent, that should have been here. All right, so now let's go and look at the accounts that are missing. So the first thing is accounts receivable. Notice how it went up. Then we have inventory went up as well. Prepaid expenses went up as well. And the investment in the subsidiary, I thought we dealt with that one if I'm not mistaken. Yeah, we dealt with that one already. So let me cross that one out. That one we don't need to explain anything about. Okay, but we can do these three right here real easily. Those are straightforward, using the the rule for adding and subtracting the working capital accounts. So increase in net accounts receivable, that's subtracted 116,424. The next one was inventory, increase in inventory. That was negative 131,700. And then the increase in prepaid expenses, that's also subtracted, and that was minus 4,000. So I'm kind of quickly going over those since those are just pretty much mechanical, okay? And then we have something else here that's kind of weird. The cash surrender value of life insurance, so the value of it went up. So it's like an investing activity, but this is, we don't receive money for this, so we might be marking this to market, all right, or to the, not to market, actually to the surrender value. So as the surrender value goes up, we've been marking it up and recognizing income for that, but that's an income that does not have a cash flow inflow. So we have to go in there and subtract that out from the investing activities. So we'll go in here and say the increase in the life insurance surrender value, that's minus 504. Okay, so that's that. Decrease in the allowance for uncollectible accounts. Let's go look at that. All right, so this is explained. I'm highlighting everything that is explained. Did we explain land? There's nothing to explain with land. We weren't told otherwise, so we're just going to assume nothing happened with land. Copyrights weren't told otherwise, but if it went down, most likely that's the amortization of copyrights. So we're not going to do a T account for that, but just like when we did patent, it went down by 10,000 right here. For the copyrights, it went down by 10,000. So we're going to do the same thing. We're going to add 10,000 because that was an expense that did not require a cash outflow. And then finally, we should have allowance for uncollectible accounts as the last thing. Oh, we haven't done accounts payable. So accounts payable went up 19,800, 19,280. I'm sorry, 19,280. So let's go ahead and do that. That's 19,280. And then the last one is the decrease in the allowance for uncollectible accounts. You're going to treat that the same as a working capital account. Since it's a contra asset, it kind of behaves like if it were a liability, right? But that 4,700 is going to be subtracted. So minus the decrease in AFUA. Okay? So after you do all that, that was a lot of work, I will admit. After you do that, you'll notice that the change in cash goes back to what we were aiming for, right? It confirms that. So the value of this statement is that you are going in there and showing everything that occurred to get to a decrease in 20,100. Now, if you're looking at this statement of cash flows from an investor's perspective, you would be a little concerned, right? Because from the operating activities, we're not generating cash flows. We're using cash flows. We're also investing in a lot of things. We're using a lot of money to grow, maybe. And where are we getting all this money from? Well, notice we're issuing stock, we're issuing bonds, and that's how we're generating cash flows to be able to operate and to invest, right? Very, very valuable financial statement. But the idea here is we've confirmed what our goal was, and our goal was to explain this decrease of 20,100. And all this work we did here is what explains the decrease of 20,100. Okay, so this concludes the two examples that I wanted to show you in terms of the preparation of the statement of cash flows. Remember, start out by identifying what your goal is and finish off by verifying that you met your goal. It's very important. And don't just become don't do these statements and just mechanically start completing them. Understand what's going on. Look at what's going on in the operating activities. Look at what's going on in the investing. Be able to use this financial statement as well, not just prepare it. All right. So hopefully this gave you a couple of good, solid examples so that you can work on other items as well. This concludes the video on the preparation of statement of cash flows.